Picture two people starting their careers on the exact same day. They take home the exact same salary, putting in the same grueling 50-hour weeks. Fast forward 20 years, and their parallel tracks have diverged. One of them has achieved financial freedom. The other is still entirely dependent on the next paycheck to cover basic monthly expenses. This wasn't a matter of one being smarter or having a streak of luck. The difference comes down to the underlying mechanics of how they treated their earnings. Without understanding these systems, 20 years of labor can result in zero cumulative progress. These are the systemic decisions that dictate who escapes the cycle of active labor. These concepts are rarely found in traditional education or standard career advice, which focuses almost exclusively on the act of earning. To prevent the same stagnation, we need to isolate these mechanics and observe how they function in the real world. Relying solely on a salary is a plan with a built-in ceiling. Changing the outcome requires a different perspective on the purpose of money. We often fall for the income illusion, the belief that a high salary is the same thing as wealth. If income alone created wealth, we would see a direct correlation between high earnings and long-term financial stability. But the data tells a different story. Lottery winners frequently return to their original financial baseline within a few years of winning. Professional athletes often see their entire net worth vanish shortly after playing contracts end. Even for high-income professionals like doctors or lawyers, net worth often stalls at zero relative to expenses. This graph shows the trajectory across these demographics, a sharp spike in income, but an equally sharp decline in assets when that income stops. The pattern repeats regardless of industry. It proves the volume of cash flowing in is secondary to the system managing it. A large influx of cash doesn't fix a broken financial strategy. It simply provides more room for that strategy to fail on a larger scale. A salary creates an opportunity, but it isn't the wealth itself. Historical data on successful investors shows a focus on capital allocation, prioritizing the destination of money over the initial size of the paycheck. The core objective is for the money to eventually work harder than the person who earned it. Think of it like these gears. Labor is the small, fast-spinning wheel. It requires constant energy to keep turning. Its real purpose is to lock into the larger gear, capital. Once that larger gear has enough mass, it generates its own momentum. The labor wheel can stop, but the capital wheel continues to turn on its own power. Financial independence is the process of converting temporary labor into a self-sustaining system. Every financial plan eventually faces a stress test. The moment the active income stops. When you stop trading your time for a paycheck, your financial reality is immediately exposed. This moment acts as a spotlight on the structural integrity of your finances. If your capital is not producing for you, by the time your labor ceases, the foundation you've built is likely to give way under the weight of ongoing costs. Returning to the two people from our opening, we can see why their paths diverged so sharply over 20 years. The first person used their income as raw material to build a foundation. The second person viewed their income as the end product, consuming it as it arrived. When the income streams stop, only one of these structures remains standing. This disparity is the result of capital strategy over time, rather than a difference in work ethic. Escaping this trap requires moving past the gross size of a salary as the primary measure of success. Success is better measured by the efficiency of your allocation, how well your earnings are being used to generate further value. Every single dollar you earn can be viewed as a tireless worker in a self-sustaining system you are designing. Breaking the cycle requires a shift from simply earning to actively building. The result of that design determines your financial reality 20 years from today. The modern financial environment moves at a pace designed to overwhelm. We operate surrounded by unseen pressures and algorithms, constantly pulling at our attention and our capital. When people think of financial ruin, they usually picture a singular, massive disaster. A terrible stock pick, a failed business, or a sudden foreclosure. But bankruptcy rarely starts with a giant explosion. It begins with the repetition of thousands of small, seemingly harmless transactions. A morning coffee, a monthly subscription, a quick online order. Human psychology isn't built to track the long-term impact of these micro-decisions. We easily rationalize a $10 purchase today, blind to how that behavior compounds over a decade. The real threat to your capital is how quietly it disappears. The drain happens right in front of you, entirely unnoticed until the account is empty. You are operating inside a highly engineered environment, an invisible spending machine designed to extract wealth through instant gratification. It literally surrounds you with constant stimuli: a push notification on your lock screen, an email about a 24-hour flash sale, a targeted ad seamlessly placed in your social feed. Mechanisms like one-click purchasing exist for a specific psychological reason: to eliminate the natural friction of handing over your money. The objective of this architecture is to push you into a permanent loop where temporary satisfaction replaces long-term planning. This system doesn't discriminate based on your salary. A high earner is just as vulnerable to these psychological traps as someone making minimum wage. If you walk into the modern economy without recognizing how this machinery operates, your capital will be systematically drained. The problem isn't the act of buying things. The problem is the mathematical reality of what happens to those things after the purchase. This graph illustrates consumer purchases. Buy a luxury vehicle or high-end electronics, and their value sharply plummets. But the blue line, a productive asset or business investment, steadily climbs and compounds. Time amplifies this, driving consumer goods to zero while growing investments, creating an expanding wealth gap. The critical difference between a consumer and an investor is simply which side of this mathematical divergence their money sits on. Crossing the invisible line from a passive consumer to an active investor requires a specific psychological shift. The wealthiest individuals operate with a strict framework. They treat every single available dollar as an individual employee. A typical consumer approaches their income with a single question. They look at their paycheck and ask what immediate satisfaction they can exchange it for today. An investor looks at the exact same paycheck and asks how that capital can be deployed to manufacture more capital tomorrow. Repeating that specific capital deployment question daily over years is the primary mechanism used to generate long-term financial freedom. Traditional schools rarely teach these mechanical truths. Families rarely discuss them at the dinner table. Because of this silence, millions enter adulthood carrying a dangerous false belief that simply earning a higher salary will cure their financial instability. If you acquire a rising income without implementing any behavioral change, you merely increase the scale and speed of your consumption. Without a disciplined system to direct it, even a massive, imposing salary can violently collapse and disappear entirely. Income level is mathematically irrelevant if the underlying financial discipline is missing. A high salary without a system is nothing more than an illusion of wealth. The only proven, reliable defense against the invisible spending machine is absolute financial discipline. Utilizing a strict, automated system designed specifically to acquire productive assets completely levels the economic playing field. This chart shows the long-term compounding effect of an average, everyday income directed consistently by a disciplined system. Even though the initial bars start small, they rapidly scale upward exponentially over time. Eventually, the system hits a critical tipping point. The returns generated by the assets cross this threshold line, permanently outpacing the original active income required to build it. Ultimately, it is these steady, disciplined actions, repeated daily over time, that gradually construct an enduring foundation of lasting financial power. There is a widespread assumption that financial struggle is purely a matter of arithmetic. The belief is that if you are trapped living paycheck to paycheck, it is because your salary is too low. This assumption stems from the default model of survival we are all taught. You offer a set number of physical hours, and in exchange, you receive a fixed amount of compensation. You trade time to earn your existence. Yet time is a resource distributed with absolute equality. The billionaire gets 24 hours, the student gets 24 hours, the factory worker gets 24 hours. No one can negotiate for a 25th hour. If the input of time is identical, the stark contrast in output demands an explanation. One demographic remains perpetually exhausted, while another accumulates capital at a rate that outpaces any hourly wage. Extraordinary wealth is not achieved by working harder within those identical 24 hours. The distinction lies entirely in how those hours and the dollars they produce are deployed. Consider a single physical dollar. The exact moment this dollar is earned and registers in a bank account, it arrives at an unavoidable intersection. Every unit of currency you acquire faces a choice. It has exactly two possible futures ahead of it. The majority of the population routes their capital down the default path. They assign a task to that dollar without recognizing the permanent mathematical consequences of that decision. As we track the lifespan of this capital, you must evaluate the assignment you are currently giving your own money. The first possible future for your capital is the consumption system. This flow diagram illustrates the mechanics of that system. A unit of currency enters the consumption funnel, where it is exchanged for depreciating items or temporary experiences. The mathematical output is zero. The dollar permanently exits your ecosystem. Because the original dollar is gone, it must be replaced. You return to work, exchange more of your physical time, generate a new unit of currency, and drop it back into the funnel. The cycle repeats endlessly. This one-way street creates a rigid dependency. Because the money is always leaving, your physical labor remains permanently tethered to your basic survival. The consumption path treats capital solely as a temporary tool for immediate existence. By choosing this route, you strip every dollar of its potential to generate future wealth. The alternative is the wealth-building system. Those who achieve financial independence pursue ownership of businesses, ownership of investments, and hard assets. This contrasting diagram tracks a currency unit entering a node labeled asset. Instead of dissolving, you are effectively hiring that dollar as a permanent employee, multiplying into smaller, replicating units over time. These acquired assets function completely independent of physical labor. As the diagram expands into a dual-axis chart, it demonstrates that while human effort is capped by a flat 24-hour limit, the system achieves compounded asset growth simultaneously. This system operates without interruption. The assets continue to generate value and produce income even while the owner is asleep. When you place these two systems side by side over a lifetime, the gap widens. One system forces a lifelong marathon to replace disappearing dollars. The other builds a compounding army of working capital. Extraordinary wealth is achieved by building automated systems that make money work for the owner. It is the only mathematical way to break the constraints of the 24-hour day. If the mathematics of acquiring assets is this straightforward, we have to ask why more people do not execute it. The barrier is psychological paralysis, the perpetual habit of waiting for perfect timing. Many believe starting an investment journey requires a massive initial windfall or a flawless economic environment. They wait for a significant salary increase or a sudden market crash before they commit. Sobering, hesitation carries a severe mathematical opportunity cost. The calendar keeps turning, and the intention to start one day quietly becomes never. A low starting income is a hurdle, but the ultimate threat to financial freedom is the failure to simply begin. The mechanism that transforms ordinary earners into wealthy individuals is unglamorous. Instead, it relies on immediate, compounded action. It requires one single investment, one small habit, and one smart decision, repeated consistently over a period of years. Over time, those repeated decisions scale into a self-sustaining ecosystem. They culminate in financial independence and total ownership over how you spend your days. Your financial trajectory relies entirely on the assignment you give the very next dollar you earn. If you want to uncover the hidden rules of wealth building, the stock market, SIPs, and mutual funds, subscribe to Intel Shift. We break down these financial systems one documentary at a time. Mastering these rules is what allows you to permanently detach your income from your physical time.